Good afternoon, everyone. My name is Jatin Agarwal, and on behalf of ASK Investment Managers, I welcome you all to our quarterly knowledge series on ASK products. This time we are covering ASK Domestic Resurgence Portfolio, commonly known as ASK DRP. Today we have with us Mr. Kuldeep Gangwar. He's a senior fund manager at ASK Investment Managers with around 15 years of experience in Indian equity markets. He's an MBA Finance from IIT Bombay and BTech from IIT Roorkee. He joined us around 5.5 years back. Kuldeep, thank you for joining us today. In today's webinar, Kuldeep would be covering broader trends in the markets for 10-15 minutes, followed by a deeper understanding on ASK DRP. Where do we stand now and where do we see things going forward? This would be followed by question and answers. I would request all of you to type in your questions and queries related to the portfolio, and I will curate it and try to get them all answered. Over to you, Kuldeep. Thanks so much for joining us on this afternoon.
Good afternoon, everyone, and welcome to all of you. So it's about market, and when we think about market, first thing come like in which environment we are working in. So if we think about the global indicators, some of the slides which we would have discussed in past, like inflation had been a concern, a long time concern for most of the central banks, and they did respond. Respond to that particular situation by increasing the interest rate. If you take the example of US Fed, they had increased Fed fund rate by 5.4% in last 17 months. We do believe that they are coming to the top of the cycle, and the only way now lingering will be that when the rate cut will be starting. In our understanding is that most of the hard work is being done, not only for US and most of the other central banks. And same is true for our own country, like in India, like we are on pause for last 4 months in a row. So we acknowledge that inflation is there, it's persisting, and even as we speak, the inflation rate would be, say, out of the comfort zone of, say, many central banks. But there are positive development that inflation is trending down, and probably in due course of time, things should work out. So net, if we think about, say, next 6 months or a year, it appears to be the case that worst is behind, and incrementally that not a major negative news coming from that particular front. So this is the snapshot, like whether it's oil, metals, or say agri commodities, the things are coming down in last 1 year, and many things have corrected quite a lot from its peak. So oil is down almost 33%. Same is the case with supply chain normalization, like freight rates have come down, and agri has also corrected from its peak. So this was a scenario like a global situation to some extent is not worsening anymore, and it's a more of a wait and watch, like when the good news comes. If we think about, say, domestic macro, probably the things are relatively looking better in a sense that capex had been a key driver, and which is quite visible in the 9% growth for the cement and 10% growth for the steel. If we think about, say, margin expansion for most of the company, it's happening because the input cost has come down. But as we discussed, like there had been challenges globally, it led to a situation that the destocking was happening in supply chain, which impacted some export-led sectors. This is the domestic situation as we speak. Like if we think about monsoon, so there is some shortfall vis-a-vis, say, long-term averages. Its implication are that overall harvesting is relatively lower vis-a-vis normal. But if we think about, say, why it's largely muted. Still, that tractor demand is quite resilient. So we have yet to see like how this adverse weather is going to play out in terms of its repercussion for the overall economy. But as it appears to be the case that government is trying to preempt the situation by giving a decent hike in the MSP prices. So if we think about, say, most of the staple companies, the volume growth had been relatively muted. because we are going through a scenario that rural was still weak. It's coming out of the woods, but it will take some time. Again, if we think about, say, overall demand per se, urban was relatively more resilient, driven by better, modern trade and e-commerce. Rural was struggling. So the demand, even as we speak, also hinges on like how the monsoon would be and so on. But net, the things are not worsening anymore. It's more about, say, okay monsoon and say the people getting a decent proceeds for their harvest. So we do believe that the volume growth will start inching up in due course of time because the commodity is benign, and as the rural demand come back, it should have a positive tailwind for the overall, say, consumer sector. We believe at the current juncture, the consumer discretionary is driving the growth, whether we look at, say, domestic PV sales, two-wheeler sales. Even if you look the passenger, airline passengers, we have already reached close to the peak number pre-COVID, and it should be seen in conjunction that fares have actually increased significantly vis-a-vis the pre-COVID scenario. Still, the number of passengers are at least at par with what they used to be in the pre-COVID scenario. If you think retail credit growth, it's quite robust, like 21% plus retail credit growth, which suggests that on-ground activity is quite decent. As I discussed earlier, that capex spend remain high, which is supporting the overall domestic growth. It's quite visible in terms of the cement demand, in terms of the MSCV demand, IP capital goods, and IP infrastructure. So net, government is doing it bit by doing a lot of capex activity. It's having a multiplier effect, and which is a good news for the overall economy. So CPI, as you will remember, that recent past that they were shoot up in some of, say, perishable goods like tomato, etc., which had some implication for CPI food. But the core CPI was still okay, like close to 5%. Those exceptional movement are now settling down. We believe it's more a short-term issue and should not have major long-term implication for, say, either inflation or its implication on the overall interest rate scenario in the country. So in export, I already mentioned that export-related sector, there had been some challenges, some slowdown over there. If we think about the overall flows in the market, so thankfully since March 23 onwards, the foreign portfolio investors are back, and it's having the implication for the high quality, high growth companies, because that is the pocket where most of the foreign portfolio investors do invest in. So that's the reason we have seen that the market has responded quite positively since March 23 onwards. Our domestic flow had been quite strong and always inching northward, month after month, quarter after quarter, and year after year. That continued to remain the trend. This is something we have discussed in past, that to have a decent stock performance in the market, it does require that we have to have earnings. And there are times when the earning growth do come, but it's a conversion into the stock market return are at times at a later point of time. So if we think about 19 to 23, the earning growth had been quite resilient, like 19% CAGR, though price performance had been only 11% CAGR or so. We believe that even for years to come, that earning growth for the overall market and for our portfolio should continue to be quite strong, and it should provide a decent return in, say, in coming years over there. If we think about the valuation have come down significantly vis-a-vis, say, October 21 level, and now quite close to, say, average, which is being observed at the overall market level. So if the earning growth remain quite consistent and quite robust in years to come, then a decent conversion of that earning growth should happen in the overall market rating perspective. DRP is all about, say, domestic opportunities, and we try to capture the domestic opportunities in, say, key segments like consumption, financial, manufacturing, and other areas which benefit from the faster economic growth in the country. The good part of this particular portfolio had been that portfolio companies on an average has delivered 22% earning CAGR with the same market earning CAGR of 16%. and it continued to be the case in time to come. So there had been some slowdown in the sectors like chemical, IT, metals, but those are areas where we are underweight. Rest of the areas like banks, consumption are doing relatively quite better. So this is the snapshot of how the Q1 FY24 was like for DRP as a portfolio overall. There was 21% sales growth, operating profit growth was 22%, and PAT growth was 29%, 24% or so. Full year FY24, we believe the portfolio should deliver 25% earning growth, and same is the case for FY25. So it's a significant markup vis-a-vis what we believe for the overall Nifty 50. If we look the psychographic of say DRP, it's overweight in three areas. First is the financial, like almost 1/3 of the portfolio coming from the financial domain. We have decent coverage for private banks, NBFCs, insurance companies over there. Second overweight area is consumption, where we cover say staple, consumer durable, say luxury, as well as other retail beverages companies over there. Manufacturing is significant overweight in this particular portfolio. So whether it's APL, Apollo, say Polycab, KI, those are the companies which are giving the exposure towards the manufacturing. Then there are the companies like Bharti and Reliance, which provide some coverage for say technology and telecom. This is the snapshot of the psychographic, like return on capital employed is quite decent, 30% plus. As I discussed earlier, that earning growth should remain quite strong for years to come. And that should provide a decent support for, say, in future, the stock market performance as well for the overall portfolio. This is the valuation, say, summary of how this particular portfolio has been in last 5 years or so. So as we speak, the current valuation are lower than the average, what's being observed in last 5 years. And there had been significant multiple derating. So what happens at any given point of time, the stock return or the portfolio returns are combination of two things, like what's happening to the earning and how those earnings are being appreciated by the market. In last 1.5 years, though the earning growth had been quite resilient, like 20% plus, but they had been headwind for the growth related sectors because FPIs were pulling out the money. That's the reason the appreciation of that earning did not happen to the same tune what it is supposed to be. If you look the valuation as we speak, the valuation are quite close to the trough being experienced in last 5 years. So if you think about say DRP, this particular portfolio came in June 2018. And since then, this particular portfolio has seen it all, like whether it's ILFS in fag end of the 2018, then general election, then COVID-1, COVID-2, then Russia-Ukraine. And if you have a look on the multiples, then probably we are quite close to the multiples which are being observed at any given point of time when the things were not working, like so trough of the multiple. So what happens, if we are quite close to the bottom being experienced for the multiple, that means if the future earning growth remain quite resilient, quite strong, then it can convert in the potential stock returns over there. This is the performance snapshot for DRP portfolio. So for CY19, 2021, the portfolio was delivering close to 21% CAGR, with say 19% CAGR for BSE 500 TRI. CY22 was difficult year, but many of those shortfalls are being largely covered by now. Like by July 23, the portfolio has delivered close to 16.8% CYTD return, with say 11% for the benchmark. So whatever we lost in CY22, part of that has already been covered. As I mentioned, that earning growth prospects remain quite strong, and in the normal course of action, if the valuation remain quite close to where they are, a decent part of that earning growth should translate into the stock return as well. So this is what has worked and what has not worked for say DRP in last 1 year. Say Polycab, Varun Beverages, APL, Apollo, Chola, and Redico Khitan has provided decent support for the overall performance, while say Page, Infosys, Quest, Dixon were dragging it down. We have already exited from say Dixon, Avas, and Quest in this particular portfolio. If we think about say future outlook, so monsoon has been quite erratic, thereby impacting the sowing pattern and fruit and vegetable output. So it also resulted in a scenario that all of a sudden the CPI moved quite sharply, but now it's correcting again. It's coming under the control. From second half FY24 onwards, we believe that the volume growth traction should be relatively better. Two reasons for the same. First of all, Diwali is delayed this time, so most of the good part will be happening from Q3 onwards. And as the rural is normalizing now, so it's no more a drag on the overall demand. So that net we are positive on the second half FY24. Export growth should also revive from second half FY24 because pressure due to the inventory destocking now easing off. We think overall, we believe the domestic opportunity remain quite strong, and it should get also some support from, say, manufacturing in India, where we might be working as a manufacturing for the rest of the world as well. So I will stop over here and happy to have any question which you might be having.
Thanks, Kuldeep, for sharing the detailed overview on macros and on DRP. There is a lot of interest that is building up right now, and there are many questions that have been raised. Let me come directly to some of the questions that are very important and unique. So there is one stock in our portfolio. Its name is Reliance. Recently, they demerged their financial services business into a subsidiary, which into a different company, which got listed. So are we exiting that particular counter, Geo Financial Services? And how do we see Reliance right now, as a oil conglomerate, or we look it as a technology company?
So we put Reliance more in the technology and telecom platform. So if we think about Reliance right now, in its valuation, significant portion come from, say, it's a telecom business and the retail business. So that is the way forward. Like oil and gas is more like annuity business generating significant cash flow. But obviously the growth is going to be quite limited in that particular area. So growth will be coming primarily through, say, Geo, which is the telecom piece, and the retail part of it. So we are quite positive that both these areas, whether the telecom or organized retail, should grow in time to come. So net, we are positive on this particular name. I already mentioned that we are exiting from Geo Financial Services because it's a small proportion which we received because of the demerger of the financial services business from the main company.
Do you see any threat to Bajaj Finance as far as Geo Financial is concerned? Although it would be too early to talk about this, but still your views on that?
So we should think that how big is the overall opportunity? So as we speak, Bajaj Finance will be 2% of the overall credit outstanding in the system. And system level growth itself is going to be quite decent. Like we should think that credit growth is largely linked to the nominal GDP growth. So if we are growing double digit in nominal GDP terms, so system level growth should be largely in tandem with that. And then there are the players which do better than the market, or say underlying sector growth, and they're the players who underperform. So if we go by, say, Bajaj's own history and delivery, they have always delivered much better than the overall opportunity available. So as we speak, they are just only 2% of the overall credit outstanding in the market. Even if they grow at 25% CAGR for next 5 years, probably they will be hardly close to 4% of the credit outstanding in the market. So they have done quite good in past. They are doing nicely even as we speak, and so should be the case even in time to come. So new competition will come. It had been always the case, but it doesn't mean that the people who are more efficient, always exploring the new opportunity, are the one who take a hit. It may be the case the people who are relatively more inefficient and marginal players who get say more damage when a new competition come into the picture.
You spoke about quarterly results. Lot of margin expansion happened. A lot of companies delivered inline results. Can you share us some names where there was disappointment as far as DRP portfolio is concerned?
So if you go pocket by pocket and think about, say, consumption as a basket for that matter. So Titan had very decent top line growth, but margin was relatively lower. Couple of reasons for the same, like Q1 last year, there was some one-time benefit which were not there anymore. Company was doing some marketing activities which should deliver, say, positive, say, traction in time to come. So there may be some quarterly variation, but net, if we think about Titan, we are quite confident that year overall, they should be able to deliver close to 20% earning growth. There had been positive surprises as well. Like if we think about Varun Beverages, so top line growth was relatively lower because the season was impacted by unseasonal rains. Even in that particular scenario, the company delivered more than 20% operating growth because what they lost in domestic market, to some extent, they compensated the same by better performance in international market and better control on the overall, say, its operating activities over there. Same is the case with the Radico. Radico delivered relatively better number in terms of top line. So net, I'm saying that at certain places there was some positive outcome. At other places there may be minor negative, but overall portfolio delivered more than 20% earning growth. And that would be always the case that we have a benchmark expectation and quarterly some variation do happen. As long as on annual basis the things are on track, it should be fine.
Okay. You talk about the PE multiples of the portfolio. I just wanted to understand in the current market scenario, which space or segment you feel that is attractively priced. I'll give you an example. So suppose financials comprise of almost 1/3 of the portfolio, consumption is around 1/4 of the portfolio, manufacturing is again around 1/4. So which space do you feel that is attractively valued and which space is relatively or apparently expensive right now?
So if you look financials overall, there the valuation are lower than the long-term averages. So this particular sector obviously takes some beating when the negative news around. But if you think, say, their ability to deliver earning and the return, that's intact. In fact, in last 5 years, or if you compare, say, pre-COVID scenario, as I mentioned, the valuation have come down for most of the company, whether it's a private bank and NBFC. So this is one area where the earning growth is likely to be resilient when we think in number of years, like a 3-year, 5-year perspective, and coming with relatively at lower valuation. The rest of the places, like valuation may be slightly higher than the average, like consumption may be one of those areas, but significant derating has already happened from September 21 onwards. So normalization of valuation have happened in many sectors. So as we speak, financial remain an area where the valuation comfort is obviously there. Other areas largely close to the fair valuation or maybe slightly higher.
We have seen some turnaround stories in the auto space wherein the volumes are picking up. Also in pharmaceutical, a lot of fund houses are bullish, including ours in some of the strategies. We don't see any name in the pharma and auto space in our portfolio. Any particular reason why?
So, like if you think about the options available in auto, one is the OEM piece and second is the auto ancillary. In case of auto OEMs, the demand generally is having a moderated long-term growth trend. The large part of growth do happen in the auto ancillary space. So we do not have that exposure in this particular portfolio because when we think about auto ancillary, it is primarily the export led. And if we think about this particular portfolio, main criteria for any stock to become the part of this portfolio is that it should be largely led by the domestic opportunity. So it's a situation like the domestic part of the auto probably can't grow at the same pace what we desire. And the ancillary part is more, say, export oriented. But at the same time, how we are just taking care of this particular stuff, say Chola, we are having decent exposure, more than 5% or so. So Chola is nothing but a proxy on how the overall auto sector is doing in the country. So at times, rather than having say direct exposure, we can take indirect exposure as well, because auto as a sector is relatively cyclical. So we generally avoid say cyclical things in the portfolio. More compounding is preferred. And that's the reason Chola fits the bill that we are playing the auto cycle or say overall auto sector through Chola as we speak.
And pharma?
As I already mentioned that it's a more domestic oriented say fund like for any stock to become part of the portfolio, first requirement is that export should be less than 20%. And that's the reason pharma, it had been more about say, domestic pharma earlier, and domestic pharma space is something where the valuation had been relatively higher. Nonetheless, last year we had taken some exception to the rule. So pharma may be there at some point of time, but not there as we speak.
There is one stock that is from paints, that is Berger Paints. There is a lot of news that new players like JSW or Grasim are entering into the scene, and there will be a lot of margin erosion going forward. How do you see Berger Paints going forward? And obviously, Asian Paints still going strong.
So one thing is problem statement, like some new competition is coming, which is going to have implication for the incumbents. At the same time, we should quantify like how much is the impact. So think a scenario that overall industry was supposed to grow at 10% CAGR if the Grasim was not around. Okay. And then assume that probably the Grasim take 10%, 15% market share 10 year down the line. We give the benefit of doubt, like it's happening. It means that incumbents will be having 100 basis point lower growth vis-a-vis a scenario when the Grasim was not up. That means instead of 10% growth for these companies, probably the 9% happening. Next question should be asked, like whatever they are losing in this transition period, whether that can be compensated or not. So if you think about Asian Paint, Berger Paints, these companies had been there for more than 75 years, like Asian Paint more than 75 years, Berger more than 100 years or so. They are the company who work as an example for other industries, like they are the role models, that how the business should be done, how the supply chain should be oriented, and so on. The question is like if they were supposed to grow at 10% case in the scenario when the Grasim was not around, if the Grasim takes say 10% market share, that number come down to 9%. Question is only this 1% what they are missing, whether that can be compensated or not. These companies are agile enough, they also explore. They are not basking in the luxury of past. So 5 years back, most of these companies started exploring the new area, like construction chemical, waterproofing, and so on. If somebody is covering the paint company for long, that guy would not have factored the construction chemical waterproofing, say 5 years, 6 years back. It started happening 5 years, 6 back only. And now they have become a decent player in that particular area as well. If you think about construction chemical or waterproofing, it can be as big a sector as the decorative is. So the question is about whether these dominant players are sitting idle or doing something about what they are going to lose. Our understanding is whatever they will lose in the paint, they will compensate the same by venturing into the other adjacent categories over there. In short term, obviously, whenever new competition come based over say intensity of the competition, some short term disruption do happen, but we should understand the structure of this particular industry. Like there is a respect for relative position in a sense that a business can be conducted in a certain fashion. Like distribution is an edge, and which is very difficult to surpass. So most of the leaders of the world had come to our country, but couldn't do much about it. Like whether it had been say ExxonMobil or say Sherwin-Williams and so on. Ultimately, so far nobody would have become the successful, but still we are giving some benefit of doubt, putting some number. We believe that they can be say 6 months disruption and so on. But just based on the price, it's not easy to gain market share. If it would have been the case, then the world leaders would have garnered decent market share over a period of time. So having said all this, we are doing say risk control by keeping a relatively lower exposure in that particular area. So if we think about Berger Paint, it's almost as of now close to 2% of the portfolio.
What we have witnessed is that as far as manufacturing side is concerned, so huge public capex is happening and elections around the corner. The pace has only accentuated. Like one of the portfolio companies promoter came out and said the polycap said that there was a huge volume growth and they are busy doing expansion big time. They surprised also positively on the profitability front. Do you see that because of this public capex, private capex will also improve significantly going forward?
It's already happening. So as you mentioned about polycap, so it was very strange situation in the market, like whether it's a KI industry, havers, people did not have capacity at all. Like there was such a demand scenario that KI is working close to 90% capacity utilization. Same would be the case with Havels. So, and it's not only about domestic, even the export demand is quite robust. Like when we say China plus one, it's happening even in this particular area, like a country like US, etc., looking for alternative. And US itself is almost 20% of the overall cable demand in the say world. So they don't have the local capacity to compensate their own demand. So right now, it's a these companies are in a quite sweet spot. Like rest of the world is also asking for the delivery as well as the domestic one as well, and they are in a situation where the polycab is probably the only player having a decent capacity available. So what happened in Q1 probably should continue at least for a couple of quarters before say new capacity come into the overall market. So it's happening through the capex being put in by government. It's happening through the private capex as well. So right now we believe the capex manufacturing, they are going to stay, and that's the reason we have significant overweight in that particular area.
We had one export oriented stock, Infosys, in our portfolio. We exited from Infosys. Any particular reason why we exited from Infosys?
So we are looking like what else can we put in place for the same. So we are in transit mode for that particular stage. Because if we think about IT, obviously it's a good sector, generating significant cash flows and so on. But growth is a concern. It had been a concern in pre-COVID scenario and should be the case in time to come as well. So to provide say extra support for the growth of the overall portfolio characteristic, probably we will be looking alternatives where the growth trajectory may be relatively superior.
If I were to ask you that how much of the portfolio, what percentage of the portfolio is focused on domestic manufacturing right now?
So right now it's a 20% plus, which is directly getting benefit from the manufacturing activities. So significant overweight, what is there in the benchmark.
Okay. You have answered most of the tough questions, and I would like to appreciate the fact that the growth strategy has not done well across most of the portfolios, but your portfolio has done relatively well and has outperformed the benchmark. Considering the fact that PSUs did exceedingly well in the last 1 year, also some of the value and contra names also delivered stupendous returns. What is the genesis, or how was it possible for you to generate good returns, considering the fact most of the growth portfolios are underperforming the benchmark?
So two things worked in favor, like it was more domestic focused portfolio. And as we say, probably India will be the bright spot in the overall global scenario, not for now, even for years to come. So this strategy is more about say domestic opportunities. And that's the reason it did not have the same impact what other portfolio where the export oriented names had been there, primarily in the area of chemical, auto ancillary, and so on. So this is one positive part. And because we were having exposure to different consumption names, primarily in the discretionary side, they have also delivered quite well. And second piece I mentioned, like there was significant higher exposure towards a manufacturing theme, though we were playing indirectly through the name of Polycare KI, in addition to the APL Apollo, etc., which has done quite well. So this is something like India is going to have relatively superior growth for years to come, and probably this that is the anchor theme for this particular portfolio. So we remain quite confident for the earning growth delivery for years to come over here.
Yeah, I think with that, we are through with most of the questions. I thank you, Kuldeep, for sharing your detailed thoughts on the portfolio. It is always a pleasure getting such insights from you. A sincere thanks to all the participants on the call for showcasing faith in ASK. Our endeavor would be to connect with you and keep on sharing these insights on a quarterly basis. With regards to today's call, we would be sharing the recorded link of this call at your email addresses. Once again, thank you all for joining in. With
Thank
this, we would like to conclude today's session.
Thank you, everyone. Thanks a lot.
Thanks.